Today we're going to talk about chapter 12. So in this chapter, we're going to talk about money, banking, price, and monetary policy. So here's a list of topics we're going to discuss in this chapter. First, I'm going to explain to you what is money and how money is measured. And then we are going to construct a monetary intertemporal model. So essentially, we're trying to understand what determines the quantity of money and what determines the price level, right? We're also going to look at feature relationship. Essentially, it's a relationship between nominal interest rate, real interest rate, and inflation, right? After that, we are going to develop a competitive equilibrium model with monetary intertemporal choice, right? And then so we are going to use our model to understand some experiments or like policy change. Say, for example, if suddenly there are more money flow in the economy, what's going to happen, right? From these experiments, we're going to see money is neutral, meaning money is going to have no impact on the real economy, right? And then so we're going to look at what the factors can cause the money demand to shift and how a shift in the money supply is going to, or demand is going to affect economic variable in this model. We are going to close this chapter by looking at some unconventional monetary policy in case when conventional monetary policy becomes ineffective. This particularly happens during the 2008 financial crisis. First, what's money? So money is any financial assets that have been widely used by everyone as a means of exchange to serve as money. Okay, so these financial assets needs to have three functions or need to satisfy three requirements. It must be a medium exchange, meaning everyone accept that, except as something you can exchange for goods and service. Okay? So money is extremely useful in that sense, in that aspect. Just imagine without money, so if you want to buy something, what are you going to do? Right? So we need to double-sided coincidence. Give you an example. I'm a professor. Okay, so the good and the service produced is economic lecture. So for example, I need some food. So for example, vegetable. Okay, so without money, what I must do? Let's just use A and B. A denote me, and B denote to potential sellers, right? So I need to find out someone. Okay, so what I need, so here, what I can supply is lecture. What I demand is fruit or vegetable, either way. Now, so in order to trade my lecture with fruit, without money, what I need to do, I need to find out someone who supply what I need, which is fruit. And then, so demand what I have, which lecture. You can see this is going to take a lot of effort or lots of law, right? You need to find out someone who has the opposite things compared with me, right? So this is what we call the double-sided coincidence. So maybe in the case, okay, so you find a C. What happens is C is going to supply and demand. Let's say, for example, say he or she may supply meat and demand lecture. So in this case, I can go with C, can use my lecture to exchange for meat. Now, finally, so it goes to C. Okay, maybe the more visible case is C. B is going to supply fruits, but demand meat. Now now this meat goes to me, right? And then I use the meat to exchange fruits with B. So you can see this becomes very complicated. right? Why? Because we have to use one good to exchange for another goods. Now with money, everything becomes easy, right? So I give a lecture, I get paid, use the money, I can buy whatever I want. So this is medium exchange. Now, what's store of value? So essentially, just says your hard work. Okay, you can put into this money, and then this money is going to keep the value so that you can use for future period or later stage of your life. The third requirement is unit account. What this means is just you can give a yardstick to measure the value of any good and service. Right. So, for example, the fruits is like $5 per pound. Meat is $9.25 per pound. Right. So you have a unit of account for the value of the good and service. If something satisfies these three functionality, or if something has these three functions, and then we just usually call this money. And in human society, we have different kind of money. Actually, we start with commodity money. Let me write down commodity. So essentially, this is something. It has intrinsic value. In human history, we have used, say, for example, gold as money. Those are precious metal. Okay? And in some society, we use clamshell as money. Right? Second, we use commodity bag. That's short C, backed. Meaning, so the money itself has no intrinsic value, usually like a piece of paper or certificate. However, so this piece of paper guarantee you have the right to get exchange with certain amount of commodity. Right? So in that sense, so any piece of paper is supported by certain amount of commodity. Now go to more recent history, or currently we use fiat money. Fiat money. Now, so again, this is similar to commodity-backed money, but we go one step further. There's nothing to support. I mean, it's no commodity to support. But what is going to support the status of the money? Actually, it's a reputation of the government. It's like guaranteed from the government, right? So this is money. How we measuring money? So there are three concepts. Number one is monetary base. So basically, that is currency in circulation, like the dollar bills, coins. So you have. And the plus bank reserve. What is bank reserve? So in principal clause, you probably have heard that. Say, for example, I have $1,000 cash. Okay, and then so I just deposit in the bank. Now, so this $1,000 of cash goes to the bank. Bank gives me a certificate. But what the bank is going to do with this $1,000? And usually, so they're going to invest or make loans so that it can make a profit. But to make the banking system sound and reliable, usually, so the central bank requires the commercial bank leave aside a fraction of this 1,000, and we call the bank reserve. This is in case if I need cash or leave money or I want to withdraw, and then so the bank have some reserve to satisfy my need. Now usually like 10%. So this is bank reserve. Okay, so this bank reserve is actually this requirement of bank reserve actually is part of the money supply from the banking system, as we discussed in principal clause. I leave that for you to read for your principal clause. But in any case, so this bank reserve is part of money base, right? So now, if we go to M1, which is actually this core definition of money supply, is currency in circulation. Currency in circulation. Plus transaction deposit, traveler check, and demand deposit. right? So this sounds a little bit complicated, right? So basically, you can simplify this as, so this including currency in circulation, cash, coins, and the rest of them essentially you can just take it lightly. Just say this is like all your money in your checking account. Because the checking account is kind of very liquid. You can use anytime as you wish. Right. Now, what is M2? M2 is broader. M2 includes M1. And then the other big things include in M2 is saving deposit. So essentially it's the money in saving account. It's less liquid. Usually you have notify your bank, or in modern days with mobile banking, you need to do this on your cell phone, right? So this is similar to the money you have in your checking account, but slightly less liquid. And this saving deposit, and they have retail money market fund. So largely is your money you put in your brokerage account. Like if you want to invest in TD Ameritrade, or you can, if you want to invest through Robinhood or Fidelity, you put some money there. So this is M1, M2, and a monitor base, right? Now let's look at inflation rate. Okay. By the way, ignore these. This is some editorial problem. Okay, so let's look at inflation rate. Inflation essentially measuring the percentage of price change. So what is P? P is the price level in current period. Okay. Usually you may think about P as CPI or something similar. Okay, this price level. This is not like one good. But in economic model, so sometimes we say, okay, so there's only one good, just simplify. But this one good is just essentially is a bond of goods. And the P prime is the price in next period. So hence the numerator, we can call it delta P, change in price. Denominator is the price. So hence this is a percentage change in price level. So that's give you the inflation rate. Now we are going to learn this famous Fisher relationship. Okay. So to understand how we end up this equation, just imagine. So first of all, this is a real interest rate. R is a real interest rate. And this R is nominal. Okay. So how would you derive that? So 1 plus R, this is what you're going to get if you, real interest means, okay, so if I put 1 unit of goods aside today, then tomorrow I'm going to get 1 plus R unit. This is in terms of goods. This is real rate. Now the real rate, so this is going to be, okay, so tomorrow what I'm going to get? So tomorrow I'm going to 1 plus R, this is nominal, right? But then, so I need to divide it by divided by prime, P prime, right? Because I need to convert into the real goods, because tomorrow the goods, the price of the good is going to P prime. And it's similar today, so this is 1 unit, right, times 1 over P. Okay, what this means? In a nominal term, I set aside $1, and tomorrow I'm going to get R1 plus R dollar. But this $1 today is going to give me 1 over P unit of goods. And then tomorrow, so this 1 plus R is going to give me 1 plus R P prime units of goods. So this is in real term, right? And this real term is going to give me 1 plus R. And this 1 plus R must equal to this term divided by this term. That's what I just wrote down. So now look at what is this? What is this? Go to the previous slides. So that's exactly here, right? This is exactly here. Okay. All right, so this is how we derive this feature relationship. We just show you how real interest rate, nominal interest rate, and inflation, they are related. And furthermore, if R and I actually in reality, those are usually a small number. If those are small number, usually, so we can approximately get R, the nominal interest rate equal to, sorry, real interest rate equal to nominal interest rate minus inflation. To give you a numeric example, if you just save your money in the bank and the bank says, I'm going to give you a 3.5% of interest rate, but the current inflation is 2%. And then meaning in the real term, you're going to get 1.5% of return by saving $1, $100, $1,000, whatever amount you have. Now, this is very intuitive. So the nominal return is just what you get in the market. But inflation is going to eat away part of the purchasing power. Hence, you need to subtract that. Right? But this one, if you just write slightly different, and then so you can also have this just like a pure algebra. R roughly equal to R plus I. So this suggests the nominal interest rate is going to be positively correlated with inflation. Okay, now let's look at the data. On the horizontal line, you have inflation rate. Vertical line, you have nominal interest rate. Right? Let's just copy what we have in the previous slide. R equal to or approximately equal to I plus R. Right? So if we look at the data, approximately, yes, there's a strong positive correlation, except if we are here. What happened here? So you have nominal interest rate close to zero. And the nominal interest rate usually always positive. Okay. And then there are two questions. Number one, why nominal interest rate is always positive? Number two, and what this means to monetary policy, or why we are here, it seems like the nominal interest rate and the inflation rate, their relationship start to break down. Let's hold the second question to the future slides. Let me briefly explain to you why nominal interest rate never below zero. Just imagine if nominal interest rate is -1. What this means? Meaning, if you save $1,000 in the bank, you're going to pay the bank for $100. Sorry, $10, right? So I just said 1%. You pay $10 to deposit your money in the bank. Will you do that? No. So you probably just keep the money at your house. So this just says usually, so nominal interest rate must be positive. But in reality, it can go to negative territory. Just imagine if you have $1 million instead of 1,000. Then to safely guard or keep this $1 million at home is pretty costly. All right. And then so you may want to pay a little bit to the bank. They just theoretically discuss. So whether it's possible, the nominal interest rate goes to negative, but in general, it's not. Right. All right. To summarize here, so you can see there's a nice positive correlation between nominal interest rate and inflation, except when nominal interest rate goes to zero. And I actually explained to you why nominal interest rate usually is above zero. And this positive correlation coming from the feature relationship. And how we develop the feature relationship. So essentially, we just set up the connection between real interest rate, nominal interest rate, inflation, price, or price level. Right. Another thing I want to highlight is real interest rate. Okay. So the real interest rate kind of fluctuate, not only fluctuate, and since 1980s kind of decline. right? So this play an important role in terms of government policy making. All right, so we will pick up that later. All right, so now we are going to move to the second or third topic. Right? Trying to understand the money demand, money supply, and then so we are going to build up intertemporal monetary model so that we understand what determines the price level and what determines the quantity of money. I want to highlight so far. So in all the model we have discussed, there's no price, right? Or there's no nominal price, right? So there's no change in price. Everything's in real term in terms of goods and service. Now here, so we'll start to understand what determines price. Okay, to understand what determines price, now we need to do some simplification or some assumption regarding the model. Number one, we assume all goods must be purchased through some intermediaries. Right? Certainly, you can use currency like a cash. Alternatively, modern day, what you can do? You can use credit card. Right? And the credit card is a little bit different from currency. Right? So how they're different? Currency essentially is what? Essentially is cash. But who issued this cash? So basically, so the cash is IOU issued by the Treasury Department, right? Because the currency was printed by the Treasury Department, and the Treasury Department give to you, right? And then pay you whatever, okay? So that they can get some goods and services like government purchase, or if you work for the government, right? So they just give it to you. And then, so use this currency, you can buy goods and service. Right, so this currency, but essentially this currency is IOU from the government. And then when you buy goods and service, this IOU transfer to the seller or the business who sold goods and service to you. So this is currency. Now what's credit card? Credit card. So first, when you use credit card to buy goods and service, right? So you essentially, you wrote an IOU. You wrote an IOU to the credit card company, right? Because later, when your bill is due, you must pay the credit card company, right? So you wrote the IOU to the credit card company. But actually, this IOU was transferred from you to the business. Right, so eventually, so you have to pay your credit card. This is so. First of all, this is a little bit different in terms of who writes IOU and who's get involved between the currency and the credit card. And then secondly, so the credit card usually, so the transaction cost is a little bit different from money. I mean, from currency, right? It's currency essentially printed by the government, and the credit card is issued by the credit card company, right? So they will be different in terms of cost. Okay, in terms of cost, right? All right. So now let's say the goods purchased at price P, okay? And we are going to assume, so whether you use credit card or currency, so the price is going to be the same. But in reality, it may be a little bit different. Okay, for now, just simplify. So they are the same. This is our starting point. Now, first of all, that's for sure. You can always buy goods and services with currency. There's no problem. Okay. Now, let's just take a detour to understand what would happen if you buy goods and services using credit card. Okay. And remember, so there are two ways, right? So if those are all the transaction, you either use cash or the currency, or let's call it money, or you use credit card. Okay. If we understand, so what determines this part, and immediately we are going to understand what is going to determine this part, right? And furthermore, so the side of this pie, like a total transaction, usually is correlated with output, or GDP sometimes called, or income. Right? So these are correlated with this. Right? So now we are going to focus on, okay, so what's going to determine the demand for credit card? So let's use Q to denote the cost per unit of goods when you purchase with credit card. So essentially, this is like a transaction cost, administrative cost, right? And then, so this credit supply by the bank, usually we say it's going to increase in Q, right? Or in other words, if the cost increase, per unit cost increase, and then the supply is going to increase. Why? Is because just supply credit card service is costly, right? So the more you supply, the more costly it becomes. And this is going to be denoted by this diagram, right? On the horizontal line is quantity of credit card service. And the vertical line is price for credit card service. It becomes more and more costly to provide the credit card service. Because you need to verify, you need to do lots of transactions. Okay. Now let's look at the demand for credit card service. Okay, so once we understand your demand for credit card service, and then so you understand the demand for money, right? Okay, so this is like a big pie. It's just total transaction, right? And half or a part is go through with credit card, and the rest goes to money. If we understand the behavior here, and then immediately we understand what's going on here, right? So this is like indirect approach. Let's denote the quantity of goods purchased with credit card as XD, which is going to be a function of Q, right? It becomes more costly, and then it's going to be more, right? So this is what we expect here, right? So the price per unit card. So the overall, the quantity supply is going to increase, right? Certainly. So the bank or the credit card company is going to make more profit, so they're going to supply more. Now let's look at the demand. Okay, demand. So first of all, good purchase with currency is going to be equal to Y minus this is what I just drew, right? So this is total transaction. Subtract the transaction. Subtract the transaction that will go through with credit card. Now look at this equation, what this means. Okay. So this is 1 plus R, 1 plus R. So this is the opportunity cost of holding cash, right? What this means, if I keep cash, if I want to use credit card, sorry, if I want to use cash to pay the service, this is scenario 1. Just think about if I use cash. Okay, so for example, you have $1 of cash, and then so what's the cost and the benefit? I'm going to this cost benefit. If I use cash to pay for transaction, the cost is that I'm going to forego 1 plus R. I'm going to forego 1 plus R. This is a nominal return, right? Because I have to keep cash. I won't deposit my money in the bank. And what's the benefit if I use cash? And then so I'm going to avoid the credit card service, right? So this Q is just the cost, additional cost, right? So I'm avoid this cost. Now, if this cost is greater than the benefit, what am I going to do? I'm not use the cash, right? Because it's just too costly for me to use cash. Meaning, so if this is the case, 1 plus R greater than 1 plus Q, so then I'm going to use credit card. On the other hand, if I use, so again, so if cash, so now if the cost is less than the benefit, meaning, so if 1 plus R is less than 1 plus Q, okay? And what that means, I'm going to pay everything with cash, meaning what? So it's better to avoid use credit card when Q is too high, right? So now what this means? This just means immediately we have derived the demand for credit card. So this is supply, right? So more you supply, more costly, right? So this is from, or in other words, more costly or more profit to make, and then you're going to supply more. But now this demand is from the household side, right? So this is going to be R. When price for credit card service, when Q is greater than R, so what's going to happen? So I'm going to, if above here, okay, so I'm going to use cash. If below here, I'm use credit card. So hence, this is like a cutoff value, right? So if the interest rate is here, and then so I'm going to use credit card. So that's why, so this demand becomes the straight line. So essentially it's going to determine by here, right? But this immediately is going to tell us what's going to be the equilibrium real quantity of credit card service. But that immediately gives us the demand for money. So Y minus XD of Q, that's demand for money. Because the rest will go through currency, right? So now let's see, so what would happen if there's an increase in nominal interest rate? How would that affect the money supply? Sorry, how would that affect money demand? First of all, if the interest rate increase, and these lines go off, and then so the demand or the real equilibrium quantity of credit card service is going to increase. In other words, people is going to use more credit card. What that means is very intuitive. Nominal interest rate increase, the opportunity cost of holding cash or use cash to facilitate the transaction increase, and then people is less willing to hold credit to holding cash. They're more likely to use credit card. Or in other words, if R increase, nominal interest rate increase, leads to money demand is going to decline because it's more costly, right? So now we end up with here. So the money demand equal to Y minus this is a credit card, right? So this is a transaction we'll go through with credit card, all right? And we multiply it by P. This is like a nominal because like money is, this is in terms of dollar. P, so this is just real term, like how many transactions or how many goods and service, right? And then, so actually we can just rewrite this as P times, this is a function of Y and R. Why? Because this is the total transaction go through with currency or cash. It's going to determine by Y, it's like a total volume. Also, it's going to matter with R, as we just explained. So if R increase, and then people find us make more sense, or in the margin, it's cheaper to use credit card. Hence, the money demand is going to determine by three things. For sure, it's price level, total output or total demand, and the nominal interest rate. Right. And to summarize how these things matters, right? So let me write down P times L of Y and R. Okay, P is for sure, this is just nominal term. Now let's look at impact of Y and R. So if real income, which is Y, increase, right? And then so clearly, so this is going to increase. Why? Because there are more currencies required to facilitate the transaction. So by the way, so this term equal to y minus x r, right? And y increase uncertainty, the entire term is going to increase. Now let's look at nominal interest rate. We just talk about increase, but decrease is just opposite, or either way, right? So if r increase, and this term is going to increase, and then this term is going to decrease, right? To summarize, if y increase leads to money demand increase, if r increase leads to money demand to decrease. Right, so those are the two key terms that matter to money demand. Now we are going to substitute this feature relationship into our equation, right? So this money demand is determined by price level, y, and this nominal interest rate, right? Okay, so the nominal interest rate equal to real interest rate plus inflation. If, for simplicity, we say inflation rate is 0, and then we end up with this equation shape. Money demand is going to be determined by the real output or real income. They're the same, and the real interest rate, right? So these actually becomes the foundation for the monetary policy back in 1970. Okay, and here, so basically it says, okay, so by adjusting these, so you're going to regulate the economy. Oh, by the way, let's just finish this part. Okay, so the first nominal money demand, this is how it looks like, right? So price level, money demand. And clearly they are, if you look at the relationship between money demand and the price level, they are linear. We have to just multiply by this term, right? Usually this, of course, is positive. So what would happen if the real income change? Like here, so you have y1, y2. So here I say, for example, if there's an increase, y1 increase to y2, what happens? Obvious. So this is going to shift to the right or increase, right? Remember, so this is L, which is y minus what? Minus x star and r. So here we only talk about y. If y increase, and then this term is going to increase. This is for given value of p. Okay, so if the current real income increase, then the nominal money demand is going to increase. Now we can bring the demand with supply. Supply, usually we just say this is the exogenous, this is from the government. Right? So the government decide, or the central bank decide how much money to supply to our macroeconomy. Right? So this is like a vertical line. If that's the case, so the supply demand is going to determine the price level and determine the quantity of money. Now, remember how we end up here. So this just, we have y, we have r, right? Because y and r, so that's going to determine money demand, not other way around. Okay, let me repeat. So money demand is going to determine by y and r. Now, money demand and money supply is going to jointly determine p and the money. But this, if we just combine with what we discussed earlier, and then immediately we have a complete picture regarding to the determination of all macro model. So let's start with the left-hand side in this graph, or A and B. A and B. All right. So what do we have in A and B? So this is what we discussed in previous chapters. So we look at labor market and the goods market. Right? So remember, households supply labor right? They demand goods. Right? They just take the interest rate as given, right? So then the labor market and the goods market, they are going to determine wage and interest rate. This is real interest rate. Everything is in real term. Okay. Not only they determine the price, they also determines the total labor supply and the real output or real income. Now with real interest rate and real output, these things are going to tell us the position of the labor, the money demand. So they are going to jointly determine price and money. Right? So this is how we determine the following things. Let me write down. So R, W, this price, okay, N, this is labor supply, and the Y, this is output. And then finally, so we have just learn how price and the money supply is going to determine. Now, so this part, those are real term. These are nominal. Right. So given the discussion we have from these slides, we are going to reach this neutrality of money supply, meaning if there's a sudden change in money supply, okay, if everything's anticipated, if we knew this is going to come in, it's not going to have real impact on the real economy. Just imagine if the money supply suddenly increase in current period. Okay? And then the level of increase in money supply is going to only increase the price level, nominal wage, and in proportion to money supply, has no impact on any real macroeconomic variable. Right? Why? It's just because that's just the logic we have to have. Right? So this is going to be determined by Y and R. Okay? Not all the way around. So the money is neutral. Look at it here. So if you increase the money supply, you're not going to affect those things. Because when households make the decision, they only care about real interest rate. Right? So they only cares about the real wage. It only matters to here. All right, so the money is neutral. But certainly, so this is, say, the households correctly expect this is going to happen. It's not a sudden shock. They knew, so the money is going to change. And then, so they accordingly, they're just going to change the price, or the price is going to immediately, instantaneously adjust with money supply change. Not just imagine if these things happen so quick, they don't have time to adjust, or they haven't figured out what's going to happen. And then things are going to be different. Let me just give you an example. Just imagine in the summertime, you go to a theme park. Okay, you go to a theme park. There's like all sorts of ride. There's all sorts of activities. Okay, and just furthermore, just simplify. If they say, for example, so they only accept a token, right? And so this is like a token issued by this theme park. And then you can interpret this as like a money, what's created by the theme park or whatever. All right. Now let's say, for example, just suddenly, so the amount of token in circulation doubles. Right? And then so it means just everyone wake up, just find out, okay, so the token in my pocket double. So for example, yesterday you only have 100 tokens, and today you have 200 tokens. Okay, and then nothing else changed. And so furthermore, just say the theme park, they don't know what happens. But from the consumer side, what are you going to do? You're probably just going to take more rides, right? Because you have more tokens and the price is the same. Again, it's because we assume, like I just said, so we assume, so the theme park doesn't know what happened. They didn't realize every household has double tokens compared to yesterday. for some reason, for some strange reason. And immediately, so you're going to, I mean, households or the workers or consumers, they are going to take more right. Right? And then immediately, so during the day, the volume or the sales is going to spike. It's go crazy. Right? At the end of the day, so theme park, what they're going to conclude. So they may just simply say, oh, you see what happens, because they have more tokens, right? And then so there are more transactions, more visits, more sales. And naively, you may conclude, okay, so we are going to issue more tokens, and then so people is going to take more right. But actually, this is not going to help. It's not going to happen, right? And so eventually, the theme park didn't realize, wait. So the reason why they take more ride is because just there are more tokens, nothing else changed, right? And then so crowd didn't, what they're going to do. So if they realize this is what happened, and then they're going to just change the price. They can double the price. Everything's back to normal. But again, the point here is, when we say neutrality, it's because the price is going to flexibly adjust. And everything is not a surprise. But in the short term, like the example I give to you, so theme park may not have time to digest what's happened. Now, they may not able to quickly adjust the price. And then in the short term, it indeed, I mean, the money supply indeed is going to have impact on real economy. But if you give time for the economy to adjust, that's not going to happen. Right? So this neutrality of money. Now let's see, so what can cause a shift in money demand, right? There are many things can cause a shift in money demand. Say, for example, if to issue credit card becomes more costly, right? So, for example, there are more fraud, right? Or there's some like technology. There's some technological issues with a credit card machine, and then the supply of a credit card is going to decrease, and then immediately the demand for money is going to increase. Is one example, right? But there are other factors. Oh yeah, this is the example. Okay, so if the credit card issuance becomes more costly, so the supply of credit cards reduce, and then so the supply of credit card is going to reduce. That immediately means the money demand is going to increase. Money demand is going to increase. Okay, this immediately means. Right, so that just says the demand is going to shift, so that's going to bring down the price level. Okay, so the more demand for money, and then bring down the price level. Right. Okay, so but in reality, the money demand, I mean, it's a relationship between money demand and the interest rate is not quite stable, right? So you really cannot see the correct patterns between money, I mean, the money demand and the real interest rate. And why this is important? This is because, so remember, so we have this equation, M equal to P times L, Y, and R, right? This is the demand. And then so we have money supply, right? So if we know this money demand is a stable relationship between with real interest rate and output, and then so if we want to regulate or if we want to mitigate fluctuation of our economy, what are we going to do? We are going to focus on here, or focus on money supply, right? Because money supply is going to change. Let's just go back. Okay, let's go back here. So money supply, right? So if you change money supply, you're going to affect the price level. So this is just in case if the demand is stable. But now if the demand is not stable, and then so you change, the money supply is going to have different impact. Say, for example, you start with here. You start with here, okay? And then you want to bring down, if you want to bring down the price level, what are you going to do? If the money demand is stable, and then so you're going to reduce the money supply. Okay, and then so you're going to bring down the price level. But however, if the money demand is not stable, as you assumed, actually as the data shows. So for example, so when you bring down money supply, at the same time, money demand goes to this direction. What happened? Now instead of bring down inflation, you lead to higher inflation. Right? So in that sense, so to focus on money supply may not be a good policy choice. Why? Just because the money demand may not stable. And the money demand is not stable, that's evident from this data. Hence, recently, so the central bank, when they want to mitigate the economy or when they want to maintain the price stability, instead of focus on money supply, now they switch to nominal interest rate, right? So, or in other words, they just focus on the interest rate here, right? Okay. So now here, just summarize the factors can cause a shift in demand for money, but that's linked to the things I just discussed, right? So to focus on money supply so that you can affect price level and eventually to our economy, aggregate economy, may not be a good solution. This requires money demand, the relationship is stable, but there are factors can cause the demand for money is going to change over time. This including new information technology. So for example, the credit card, right? So these days, so you can use credit card pretty much everywhere, right? So as long as you have, so for example, you have a phone, because remember, it's like people can use like Square. This is like this is the new technology, right? You just swipe your card, right, with this like small machine, right? And another thing similar or related, so the banking, online banking becomes easier, right? So you can use, so that's going to reduce the demand for money. And so changing government regulation, say for example, the government may regulate the banking sector, right? And such that the bank need to keep more issue less credit card. So that's going to increase demand for money, vice versa. Right? Okay, and then so there's like perceived riskiness of bank. And then people may not want to deposit the money in the bank, and then there are more demand for cash. And finally, so there may be change in the hourly base or daily base or weekly base in the banking system, just due to some like seasonal issue. So for example, it usually during the end of the day, when the markets start to close, like for example, so the stock market close, right? So there are many trade needs to settle, and then the demand for money is going to change, right? And maybe like during the holiday season, there are more deals need to close, need to settle, and then so the demand for money is going to increase. All this is going to affect demand for money. Or since these things leads to the conclusion to focus on money supply as a policy instrument may not be a good idea. So that's why the central banks start to focus on nominal interest rate. Right? But then the nominal interest rate, when the central bank focuses on nominal interest rate, there's an issue. What is the problem? Like I mentioned earlier, the nominal interest rate cannot go below zero. In theory, yes, if you have like $1 million, you want to keep safe, and you maybe you're willing to pay like a little fee, but it cannot be that code too negative, right? Okay, so now what happens if we hit this zero lower bound on nominal interest rate? When nominal interest rate becomes zero, and then to the money and the bond, they are perfect substitute. What is a bond, and why we brought out the issue of bond? Bond is just the government issued IOU, like a government borrow from public. And then why we brought out this bond? This is how the central bank affect nominal interest rate, and how the central bank affects the nominal price level, or change the nominal supply, right? So in the principal cause, so we explain how central bank want to increase money supply or want to target the nominal interest rate. If they want to increase money supply, or if they want to decrease the nominal interest rate, what they're going to do, they are going to buy a lot of bond. So essentially, they are going to buy bond from either the government or from the commercial bank. Let's focus on commercial bank. Okay, if they purchase bond from commercial bank, usually they are going to give the commercial bank some reserve, and then with this extra reserve, the commercial bank is going to lend out to business, to households. With more money to lend, usually that's going to reduce the nominal interest rate. And nominal interest rate reducing usually is going to encourage consumption and investment. So this is how central bank kind of mitigate or regulate the economy. On the other hand, if they sell bond, and then so the commercial banks usually purchase the bond from the central bank. If they sell bond, and usually so the commercial bank has less reserve, right? Because they have to buy, right? So they are going to reduce the loan. If they reduce the loan, there are less money available in the financial market. Usually means the interest rate, nominal interest rate, is going to rise, meaning so the C and I is going to decrease. Okay, so there are two different directions, right? So one is buy, that just means there are more loans available because the commercial bank has more reserve, because they just sold their bond holding to the central bank, right? So there are more loans, and then the R is going to decrease, and the C and I is going to increase. So this is how it works. That's why we just look at M and B. Now, when we are in a zero lower bound, money, for sure, in general, so it doesn't carry any interest, right? Because you have $100 bill today, you just put there, it's going to still like $100 tomorrow, next year, 10 years later, zero interest rate. Now at the zero lower bound, so the bond also becomes with zero interest rate. These two are indifferent. It doesn't matter. Meaning, so if here, when we reach the zero lower bound, when the Fed purchase bond from the commercial bank, it's going to have no impact on the real economy. These two things just the same. So for households, for bank, for business, money and the bond, they are the same things. Give me the same return. Okay, it's just that it's going to have no impact on our real economy. like the impact here. It's not going to have no impact on interest rate, no impact on consumption investment. And usually we call this liquidity trap. Meaning, so the open market purchase of bond is not going to give you more liquidity, because for the household, for the bank, they just don't care, right? So before, okay, so they have more loan to make, right? So they have more cash, but now the cash and the bond is the same things. I'm not bothered to switch my position between money like cash and the bond, right? So we are entering the liquidity trap. So the central bank has very little to do to usually to stimulate the economy. Right? Let me show you this liquidity trap. Right? Then it's just M plus B, right? So here, so you just increase money supply, and then people is going to reduce B. And then, so these two things, what matters? So this is not going to affect our economy. Now, how we are going to address this issue? I mean, from the standpoint of central bank, what they did is they introduced unconventional monetary policy. Usually, this including two. Let's start with simple one. They introduced negative nominal interest rate, meaning so the interest rate goes to below zero, but certainly this cannot go too far. Like usually it's like between -1% and 0%. There's very little room. But again, so what is negative interest rate? Just means you have to pay the bank. You have to pay the bank for money you deposit, right? But this is very little impact. Now, the other things, or the more common things they did is quantitative easing. So instead of purchasing short-term bond, actually, so in the previous slide I showed when I say bond, it's just short-term, like mature in a few months or maximum 1 year. They are going to purchase long maturity government bond and even private assets. So private assets including a mortgage-backed security, right, from Fannie Mae to Freddie Mac. Okay, so that actually just make the households, business, or broader economies, some of their assets becomes liquid, because they can what they can do, they can just sell their long maturity government debt. Usually this is considered as illiquid. When it's necessary, they sell this to central bank, and central bank give them cash or something like cash, like short-term bond. Now they have more liquidity, and then they probably is going to do more consumption and investment. So that's going to change the long-term nominal interest rate, and it's going to have impact on consumption and investment. So that's how they mitigate the economy when they reach the zero lower bound. Right? Okay, so summarize what we did here. In this chapter, the main difference or main achievement we have done is we just consider money, or we just look at money supply and money demand. We have a simple model that determines money and the price level, right? But interestingly, so we say usually money is neutral. It's not going to have real impact on real wage, real economy, and the real output. Okay. But in the next chapter, so we are going to look at the certain circumstance. So this neutrality may not hold. Right. Right. So finally, so this chapter is kind of give us a complete picture to understand what determines real variable and a nominal variable. Let me start right here. So real variable including real interest rate, wage, labor supply, real output, right? And nominal including money supply and price level, right? So actually the price level fluctuate over time and fluctuate over a business cycle. This is something we are going to pick up in the next chapter when we talk about the business cycle.